Okay, so as usual, we'll talk a little bit about the market. We'll talk about the treasuries, the economy, how the Fed is managing things, alternative investments, and then our takeaways for the day. First of all, S&P 500 index is setting new highs constantly, which over the last month we're up over 4%, which is to be expected. Something that we haven't talked about for a couple years now is short covers. So a lot of times when you have a market or a stock that's being driven up, you may have a large short position, which means people shorting are betting that the market is going to come down or that that individual stock is going to come down in value. And eventually those shorts, while they may be right over the long term, that stock or that the S&P 500 is going to come down, which I do believe it will in the future. You have these people that are betting that, and then as a stock starts to go up, so we've seen some go up 60 points, 70 points in the last couple weeks. As that starts to happen, as you get that first day of increase, and then the second day, you have people have to buy back their shorts, which means they have to buy the stock to remove their bet that it's going to go down. So buying drives the price up. And so you kind of create this upward spiral effect where as people buy back their shares, it continues to drive that price up further and further and further. And usually you see that in an individual stock or in the S&P 500 at or near the tail end of its returns, where everybody is like, okay, I need to get out or I'm going to lose everything. And so they start buying those positions back. Ultimately, that's why I think we're seeing this market continue to rise when there really isn't any news to suggest it should. So JP Morgan's trading desk warns S&P 500 will turn volatile on the inflation numbers. So this is talking about a 1% up or down based on that number. I just produced a blog on an article that should come out, should get approved today or tomorrow, and we'll put that out on a Morgan Stanley Dean Witter analyst who thinks that it's about 20 to 25% likely that the market goes up from here to the end of the year. And he's talking about a 10% drop in the market. And I think that's probably reasonable for the end of the year, but I think that will be the beginning of a much bigger cycle. And so the blog that I wrote will kind of explain all of that. So treasuries, what you want to know about this, we're talking about yield. And I apologize for those of you who have heard this 1,000 times, but when yield goes up, that means bond values are going down. When bond values go down, yield goes up. So if we're looking at this yield chart here, you'll see in the last few months of that chart, we hit a yield peak and then came down and hit a yield peak again and then came down and hit a yield peak again and came down. And if you were to draw a line from the tops of those peaks, that would be what's called a trend line. That trend line is showing that yields are coming down, which means bond values are coming up. It may not feel that way in your statements on a month-to-month basis, but those bond values have a uptrend over that period. And inflation number tomorrow, if it comes in on time or where it's expected or lower, that will be a positive sign that the Fed's going to cut rates. If it comes in higher or hotter than expected, then it'll likely be, at least in the short term, a expectation that the Fed will not cut rates. That being said, as the economy slows, as we're seeing jobs numbers slow, as we're seeing individuals be laid off, as debt increases, as all of those things continue to rise, as defaults continue to increase on credit cards, auto loans, and mortgages, you're going to continue to see pressure on the Fed to cut those interest rates. And when that happens, you'll see these bond values go up and the yields go down. So that's the ultimate trend that I see through the end of this year and likely for the next 12 to 18 months. So you'll see those bond values, although they'll fluctuate on a daily basis and on a monthly basis, the overall trend should be up in value. Same with the tips. You'll see that same kind of trend where it peaked a few months ago, the yield peaked, and now it's coming down. You should see the same thing here. The reason the yields are lower is this is based on inflation. So if inflation numbers go up, you'll actually see the yields on the tips go up, which is why we use both the treasuries and the tips. If we see inflation go up with the long-term treasuries, the Fed's not likely to cut, and those bond values potentially go down. If inflation goes up, the yield goes up, and theoretically the price of tips goes up. So we want to have money in both positions, both with the full faith and credit of the US government, and we should see those yields come down and push those prices up. Okay. US economic growth slows as consumers tighten their belts. So we talked a little bit about this, but the first quarter of 2024 came in much slower than expected, with a 1.6% GDP number, which if you've got inflation at 3% and you've got GDP at 1.6%, that means we've got negative 1.4% growth over that quarter. So that's not a good sign for the economy. We're likely to see a recession or at least a bear market over the next several quarters. Not much of a change, if at all, in the Fedometer. Still kind of neutral on whether we're going to see a move with the Fed. I think tomorrow will have a big impact on it. Right now, they're talking about Fed movement in the last few months of the year. We'll see if it gets forced before then. Anytime you're looking at an election year, the party that's in power does not want to signal a weak economy, which at this point, a Fed cut could signal that weak economy. So they may want to hold tight till after the November election. Okay, some of our alternatives. So gold has performed very well this year. I expect that it will continue to do so. Um, Ironically, Bank of America came out and said gold could hit 3,000 an ounce over the next 12 to 18 months. I say ironically because Bank of America has the largest short on gold currently. Uh, Hundreds of thousands of ounces of short. So it's been speculated that they do that to keep the price of gold down. But now, if they're calling for gold to potentially go up, that makes me think they're starting to cover their shorts, meaning they're planning on buying or have bought gold to cover their short positions. So that would be one reason to see gold get up to that 3,000 number. And then with silver, same kind of thing. It's done very well through the last 12 months. You'll see it's up near its peak for the year, and I do suspect, as we've talked about in the past, we could see 40 an ounce on this by the end of the year. Maybe not, but I do think it's going to be a strong year for silver. So a good place to hedge against the market while there's that potential for the market to drop. So I recommend that you have alternative investments in many different ways. I do like crypto stocks, and I do personally I hold individual Bitcoin. That being said, if you're someone, which some of you are, who will do the research and jump on and uh, figure out if it's a good fit for you, learn about the cryptocurrencies themselves, absolutely, I think it's a viable way to insulate your portfolio from some downside risk. That being said, for those of you who are not comfortable going and doing the research and buying those on your own, there are cryptocurrency stocks where they're either tied to Bitcoin, so you have ETFs that are tied to the price of Bitcoin or actually hold Bitcoin. And then there are individual stocks, which is, I would call it Bitcoin adjacent, where you're not actually tied to the underlying cryptocurrencies. So you can benefit from the trading in those markets and benefit from the company itself without purchasing the cryptocurrencies. So there's a lot of positions like that you can take as well. So those are all things that you'd want to discuss on an individual basis and figure out if it's the right fit for you. But certainly I think there's a place for that in most portfolios to an appropriate risk level. So our takeaways for today and over the next month are: number one, let's see what the Fed does. Let's see how that inflation number comes in tomorrow. And know that the overall trend for the treasuries is that yields have been sinking, which means prices have been going up. So I do think we'll keep holding those positions. With the S&P 500, there's a lot of pressure on it to peak and start coming down through the end of the year. So for those of you who have larger positions or have significant gains, it might be worth looking at in taxable accounts, figuring out if we can take the gain and offset it with losses, or in IRA qualified type accounts, just taking those gains off the table and moving into something a little bit more conservative. And then finally, the gold and silver, I do expect to do quite well over the next 12 to 18 months. So keeping our existing positions, potentially adding to them through the end of the year. That's it